Is China's economy in full free fall? Well, maybe so, though the currency seems to have found at least a little bit of a respite today after 5 days of bloodletting. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to talk about China today and what's going on there, because the implications clearly seem to be quite dire, and the knock-on effects on global markets, on U.S. stocks, on the dollar, on other instruments is clearly being felt. So we're going to unpack what's going on there, why it's happening, and where things might be going next. Just a quick programming note: if you're watching this on YouTube, go ahead and jump in the comments under the video. Let us know if you think China is falling apart, not falling apart, if the influence on U.S. stocks will be significant or insignificant, and we'll include your thoughts into future shows. So let's start at the beginning. Are we in free fall? Well, let's first take a look at what the currency has been doing and begin the conversation there. So here's a chart of the US dollar CNY. This is the onshore exchange rate. I'll explain what that means in just a moment. And what you see here is the dollar rising against the yuan. So this chart going up is the dollar getting stronger, the yuan getting weaker. So you see that right now it is at the lowest levels it's been since November of last year. So tellingly, that's right on the eve of China's reopening just a month before, where the lockdowns were causing protests and various other issues. And so authorities ultimately scrapped those lockdowns and chose to reopen instead. Now, what I mean when I say this is the onshore exchange rate, China's exchange rate system is an absolute web of complicated, overlapping currency benchmarks. There is the exchange rate that's used on mainland inside China. That's what this is, USD CNY. This is managed. So every single day, the authorities set what is called a fixing rate. And the exchange rate is allowed to fluctuate up to 2% in either direction around this rate. Then there is the offshore Yuan, USD CNH, which we won't touch on here. It's not material to the meat of our narrative here. That's free floating and traded out of Hong Kong. And that sort of is used to give a sense of market forces that Chinese authorities then use in setting that daily fix. The idea is they really shouldn't veer too much from each other. We mentioned the USD CNH because this is also what markets look at to get a sense for actual supply and demand for the currency. And so both Chinese authorities and the markets look at this USD CNH level and try to figure out where this CNY level is likely to go. And typically they are in almost perfect lockstep. Here's what's been happening. So the orange line here is the spot rate. That's this. That's what we just looked at. The red line is that daily fix. And you can see here the oscillations around it. So you can see that at the beginning of the year, those oscillations were relatively modest. Those two lines were very close together. More recently, you can see the spot rate is trying to veer away from the rate at which Chinese authorities set it every day. And the bars that you see there give you the spread between the two. So you can see that right here, most recently, the divergence has become very significant. Tellingly, the last time that it was this significant was where we saw the exchange rate at comparable levels back in late October, early November of last year. And of course, this is where Chinese authorities were forced into reopening. So we're clearly at critical levels. But it gets worse. This is how the daily fix has performed relative to expectations at the banks, in this case polled by Bloomberg, for what it should be. So, as I say, they're looking at the CNH rate that's free floating out of Hong Kong. They do their modeling, and they figure out what they think the fix will be. And you can see they tend to get it almost spot on. Through much of this period right here, there's virtually no change. But right here, and of course right here as well, appropriately enough, the divergence is very significant. So you can see the orange line, which is the survey, peek out from behind the actual number. And at this point, the gap is almost 1,000 pips. So what that's telling us is Beijing authorities are really trying to signal to markets to stop selling yuan by setting the daily fix for a stronger currency, and then, of course, implementing these 2% up or down thresholds around it. That's them essentially checking the markets and saying, back away, we don't want the currency to weaken further. We'll see if this holds up. It held up today. So after 5 days of aggressive losing, today the yuan is a little bit firmer. So there was an aggressive shift in this gap overnight, as we can see here. And for the moment, the markets took the hint. But whether this continues to hold up, uncertain, and arguably unlikely, because the underlying issues remain the same. The problem with all of this isn't that the markets are attempting to beat down the yuan, that the dollar is rising for its own higher for longer Fed reasons, and all of this is creating a rapid sell-off. The problem is why that rapid sell-off has been occurring to begin with, dollar influence aside. Because, of course, the yuan has done much worse against the dollar than have other major currencies. This certainly makes the conversation about a BRICS alternative to the dollar even more laughable than it was when it came about. But the larger issues are really Chinese-made. This weakness in the currency, the outsized weakness, is really a function of, as ever, monetary easing. China has been cutting rates, and most recently did a surprise rate cut just at the beginning of this month. That's this right here, this latest decline in the 1 year and the 7-day rates. 15 basis points on the 1 year, 10 basis points on the 7-day. And you can see we've been easing to the tune of 25 basis points so far this year on the 1 year and 10 basis points on the 7-day. Now, as ever, and as it happens really with any currency in any economy, when you cut interest rates, that's making borrowing cheaper, but also making lending less lucrative. And so when interest rates are cut, a currency tends to fall because holders of that currency find it less lucrative to hold. So it is these interest rate cuts that are giving us this outsized yuan weakness relative to other currencies against the dollar that's really riding roughshod over everything over recent weeks in any case. Why are they doing it? Well, we've talked before about China's inability to really get its economy off the ground after reopening because it is still the global value add center, mainly. It is still that middle node in the global supply chain where raw materials are imported in, labor is applied to get them to finished and semi-finished state. They are then re-exported for markets primarily in the United States and core Western Europe. At least those are the big pockets of demand. What we saw with China's reopening in December was quite a bit of catch-up. By the time they did that, growth at its biggest customers, you can see here, had already peaked. We're looking at composite PMI numbers here, which capture services and manufacturing sector growth together. As ever, it's in the logic of PMIs. So above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go under 50, the faster the contraction. So we see the peaks in US and Eurozone growth occur already by around mid 2021. That's where boosts from stimulus really peak out and catch up growth from reopening and scrapping COVID-related restrictions on economic activity really start to peter out as well. You get, of course, a massive catch up in growth as those things initially occur, and then that growth starts to fade. It obviously is helped in the fading by an aggressive rate hike cycle that starts to get talked about in June of 2021 and really gets underway in early 2022. So by the time China reopens and says, hey, everybody, we're here, let's do business, number one, they've been gone for longer than people have needed the kind of middle of supply chain help that China was critical for before the pandemic. And so there's been diversification and supply chains have adjusted, at least to some extent. On the other hand, on top of this, rather, you still have the tightening, you have the fading growth from the catch-up, and you end up with much less demand than what China enjoyed before the pandemic. And so they never really get off the ground because they never really plug back into the system with the same vigor and with the same importance that was there before COVID. So that's one reason why there's this easing, to try to revive this economy, to give it cheap credit, to try to kickstart it. The other bit is a housing crisis. So what we see here are two indicators. The yellow bars are the Bloomberg House Price Index. It works just like a PMI index. Above 50 is positive, below 50 is negative. And what that's telling you is what share of a 70-city average is reporting house price gains, so more than half, over 50, or less than half, under 50. And what you see here in the red line is just the average house price year-on-year growth rate for those 70 cities. So what do we see here? First, we see that already, as we were maybe a year away from reopening. Less than half of cities are reporting house price gains. And in fact, it slumps significantly, even approaching at one point single digits. So this would speak to most cities reporting house price declines. This right here is the reopening, which, as we can see, has now fizzled, and we're back to seeing only about 30% of cities reporting housing price advances, which means that 70% of them are reporting declines. And then the red line here, the price itself, is telling us that the growth rate in property values has been slowing basically since mid-2019. But as of April of last year, it's outright shrinking. So at this point, house prices aren't just growing at slower rates. Now, since April of last year, they're declining. Now, this is, of course, a huge issue. It's a huge issue because so much of Chinese economic growth has been built on borrowing a bunch of money and using that for vast infrastructure and building, which then creates jobs, creates economic activity, creates consumption, and powers the domestic part of the economy in large part. Well, this kind of decline pointedly undermines that whole thing. We've, of course, last year had the failure of one large property developer, Evergrande. Now, this month, we might be on the cusp of bankruptcy at another, Country Garden. So we're looking at a situation here that too would ostensibly benefit from stimulus, from more liquidity, from lower rates. And so that stimulus is pointed here as well, not just reviving the export engine, or at least offsetting for the misfire of the export engine and the value add engine, but also for attempting to arrest the collapsing housing market and property market more broadly. If we look at what the markets are expecting, they foresee more easing. If we see the implied policy curve currently, we can see more easing is expected even 1 month forward. And we can see that the curve has flattened substantially relative to where the reopening began. That's the big dotted line. And even just a week ago, massive declines there, as a matter of fact, for a week-on-week move. We've flattened about the same amount, just eyeballing it, between reopening and last week and this week. So expectations for easing have really ramped up. The markets are saying to the central bank, you need to do a lot more here in order to address these issues. The problem is it's not working. So we saw just moments ago here, China has been easing for a while. Rates have not really gone up. They stayed steady through a lot of the COVID experience, but they've been tracking lower. And when we look at borrowing data, it plainly has not inspired people to go out and take out loans. The most worrying is perhaps the new loans number, which at this point is the lowest since April of last year. So there's tons of credit being made available, but the take-up on it isn't there. And when we look at financial conditions, they're not really improving in a hurry. So what this is a Citigroup measure that tells us, are conditions tighter? Are they looser? Is credit cheaper? Is credit more expensive? Is it easier to get or harder to get? When the number goes up, that's more expensive, harder to get credit. When the numbers go down, that's cheaper easier to get credit, the kind of things that might help with a flagging economy and a flagging housing market. Well, as we can see here, going all the way back to the beginning of last year, all the efforts that we've seen in recent months haven't really moved the needle. We're basically sitting on the 6-month average for this rate. So there hasn't really been progress, and Chinese stimulus hasn't really worked, except for beating down the currency. And here, the situation can get a lot uglier and a lot more difficult to manage. This is an estimate of the makeup of Chinese CPI that was done by Bloomberg. China doesn't actually release exactly what the makeup of the basket is. This is, let's call it a well-informed estimate. So, what do Chinese consumers primarily spend on? You can see that there's a lot of small assorted things, but they certainly spend a lot on housing. That's a big piece. And they spend a ton on food. That's the other one. Transportation services, that 14.5% component, that's something that is mainly fuel. And there you probably have a little bit less of an issue because, of course, crude oil prices have been relatively weak, and energy is now a disinflationary force in most of the world's economies. China is almost certainly not an exception. Housing is an interesting one here because spending on housing in the midst of this kind of a collapse, probably something of a tailwind for consumers. But of course, only kind of. If you're a property owner, this doesn't help in any kind of a meaningful way. But the real issue is on the imported goods side. And there, food is a huge concern. That's a fifth of CPI. If you want to toss in alcohol and tobacco in there as far as mostly imported stuff, then you end up with quite a large share. But even holding that aside, there's plenty of alcohol and tobacco products that are domestic in China. But food is a huge source of imports. And when the currency weakens like this, the purchasing power of food and of all imported things, but most importantly, of course, food, you can live without some things, but you can't not eat, that is significantly eroded. And the problem is that the central bank is not only expected to ease further, which is likely to pressure the currency further, but ostensibly needs to. Because in order to afford any of these things, there needs to be economic growth and jobs. Tellingly, China has stopped publishing youth unemployment statistics this week. For what reason, one couldn't possibly imagine, except that it was double digits in the latest readings. So, in order to revive growth and arrest the decline in housing, what China has to do, according to what the markets seem to be anticipating and calling for through the pricing of rates, is ease monetary conditions further. The consequence of that will be to erode the purchasing power of the currency and thereby make it more difficult to buy baseline imported staples, food most critically among them. And there you have a big social instability concern. And of course, all through Chinese history, it is failing to provide food and jobs that has led to major upheavals that have seen dynasties change hands. So the potential for a very significant issue here that is devilishly difficult to manage because one aspect of policy is working firmly against another seems very, very high. On top of this, of course, the dollar is marching higher all on its own, and the Federal Reserve, looking at minutes from July's FOMC minutes published this week, in so much as they might echo what the Fed then says at the Jackson Hole Symposium next week, where Fed Chair Jerome Powell is due to speak, the Fed is focused firmly on inflation. The market doesn't expect any more rate hikes this year, but the chances of one have been creeping up a bit. The degree of easing expected next year has receded. A March rate cut now has fallen out of the forecast. It was as much as 80% likelihood assigned to that at the beginning of last week. It's now down to around 30. And the path thereafter has significantly flattened. So now, all of that is likely to feed continued dollar strength, even if China does no more easing. But of course, the market is beckoning them and demanding that they do it. And if they don't, they erode purchasing power on the housing side. But if they do, they erode purchasing power of imported goods. And so you end up with a very difficult situation indeed. Now, to trade this, there is a range of assets, some of them ETF instruments in the U.S. like FXI, the iShares China Large Cap ETF or ASHR, the Xtrackers CSI 300 index. This is the catch-all for A shares, the preferred shares, on the collective Chinese stock market, both Shanghai and Shenzhen composites. There are those instruments. But they oftentimes muddy in overall Wall Street sentiment and, frankly, have not been as responsive. They're more belatedly responsive now, but they've not been as responsive. But copper, HG futures, and the Australian dollar, 6A futures, they've really been reflecting this in spades, not only because they reflect waning housing demand in China, but they also reflect waning economic conditions and general weakness. Australia is looking to China as its largest export market for primarily growth-driving commodities, coal and iron ore. And so those vehicles start looking like ways that this is traded. And although the yuan seems to have bought itself a day, it won't be easy to unspool this just by moving the daily fixed rate. And that is macro money for today. It's also the last macro money for this week. We're here Monday through Thursday every week, right after overtime, a show that we do with Chris Vecchio, head of futures and Forex here at tastylive, where Chris and I attempt to figure out what happened on a given day, make sense of the markets a little bit, and perhaps even try to see what is likely to happen next. I'm back on with Chris tomorrow, as I am every Friday, for Futures Power Hour. On again with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com and opining on Twitter, yes, Twitter, at Ilya Spivak. Once again, if you are watching this on YouTube, do feel free, and I encourage you to jump in the comments and offer your thoughts. We'll incorporate them into the show. going forward. Thank you very much for watching. See you soon. Take care.